All right. Okay. So, hi everybody. So let's have a quick look at, first of all, let's see what's coming out this coming week, news-wise. What's the big stuff? So, what's the big stuff? Home sales is always something I want to watch to get a sense of just whether the housing market is kind of shrinking or still growing. So I think home sales, but it's not really. Generally speaking, a lot of the stuff when times are good are not anything to be too obsessed about. When times are bad, you want to be focusing on, like jobs numbers or interest rates and stuff like that. But, right now we're pretty much in a bull market. My expectation, speaking seriously for the moment, aside from the global tensions around another world war, so you've got kind of Iran, North Korea, bit of China, and Russia obviously is on one side, and then you've kind of got a lot of other countries on the other side. Aside from the tensions escalating there, which are looking slowly but surely worse. I think that hopefully next year we'll see a de-escalation. The only way to de-escalate it actually is to take Russia out. Once you take Russia out, everyone else will calm down for now. So aside from that, markets-wise, everything looks really good. We're in a very strong market. Economically, there's a lot of really good stuff going on. Okay, so it's not to say it's perfect, not to say that every single person on the planet's making money. Some people are struggling, but generally speaking, the conditions now are better than for many people. So I remember pre-COVID, living in London, a lot of people were like, "Oh, I don't like my job, or I can't, or I'm struggling to find work, or a few other things." And since COVID, haven't heard anybody complain about being able to find work. Everybody's got work. So, and that's in London, which is not really a big growth kind of city. I wouldn't say that it's one of the bigger ones. So it's nice to see right now that at least in London, most things are fine. So point is that when there's not too much to worry about with regards to the markets. Really, it's just kind of what could cause the markets to move. So depending on your strategy, excuse me, but you have to have a very fixed strategy trading the news. So what else do we want to pay attention to? So initial jobless claims, if there's any really big changes, like a big drop where there's more jobless claims out of nowhere, that could be a clue. So in the run up to the global financial crisis, which is 2007, so let's go through this, go all the way back as far as we can, 2002. So sort of this period here to all the way through to here. So really you wouldn't have known anything was wrong until about here. Because why? Well, because in that pullback here, until you were kind of along this period here, up until about there, this trend was still intact. Then it had to break through it. Then it had to come back up and retest it from this side. Then it came down and it broke. So this very moment here, something very significant was starting to happen. And we had a bit of a bull market, which is why the candles start to increase in size. So it's the very moment when you kind of start to break through, like you get a confirmed downtrend on the monthly, that the candles actually start to increase. That's when the panic increases. And then how do you know at what point do you know when you started to recover? That's actually kind of around about here when you break through here, when you start to go back into an uptrend, but almost for sure when you then get a higher low here, we break above here. So by the time you broke above here, which is 2012, and this period over here, which is 2010, this is really when, sorry, that's when you kind of know you're back into a bull market. So you still had to go through all of this recovery before you could say, okay, you're back in a bull market. And also you had to go through a lot of this uncertainty before you could say you're definitely in a bear market. So quite a few different things you have to watch, but right now we're not in that kind of place at all. When we go back to where we are now, we're still very much in that uptrend, and that shift to go from where we are now back into that kind of change of trend is like a 6 to 18 month kind of rollover period, excuse me, it's like a 6 to 18 month kind of period. So to go from a bull market to a bear market takes a very long time and it happens quite slowly. And so we have time to be able to observe it. So we're not there yet at all. We're not even remotely there. And also it's only a small part of the bull markets are much longer than bear markets. So if you're in a bull market, you should expect that to last 3 or 4 times as long as a bear market. So we've just, we got in a bull market at the beginning of last year. So we're still very much in the early stages. So we need to just, take advantage of that. So nothing really to be too concerned about. I would say the US stuff here, the PMI data could cause a bit of volatility in the markets, and that is pretty much it. So that being said, let's go to the charts. Let's have a look at a few different things. So I'm going to go through, let's go through the various charts as well. And let's just put this back up here. And I think let's start off with the euro dollar. So what's kind of going on with the euro dollar at the moment? So when we look at this on a daily time frame, we've got a very nice uptrend. We've got the channels looking bullish. We've just gone green on the pivot. We've got a very nice little green bullish candle. It's an inside bullish candle that's happened. We've got a little bit of support. So we've got a nice little channel of support. Entry above the high, stop loss either below the low here, below the low there, below the low there. Any of those three stop losses, believe it or not, from a more experienced perspective, are all valid. Hi guys. So those stop losses are all valid, but each one of them comes with statistical consequences, or at least there's consequences, right? So if your stop loss is too close, you could get stopped out. If it's too far, it's going to take you too long to get to your potential risk reward. So there's a definite level of resistance up here, but this is looking pretty decent here. So my expectation for now would be to see euro dollar start to climb a little bit over here on the daily. That looks bullish. Why? Something's wrong here. Sorry, this is not right. This is not right. This is not right. Where is my... okay, hold on. Give me a second here. Sorry, guys. Just for now, I'm just going to do this. Always 1 to 50, never more than that. Let's make it a US dollar 1. Always US dollar for me. Standard, yes, boom. Sorry about that. I knew something was wrong. I was like, no, we've had a very bearish euro at the moment. Give it a second. There we go. Right. My apologies. So we've had a very long correction here. We had a double top. So let's just kind of have a look at this. I usually have two different types of charts. So we'll go here. We can compare this. So you can see kind of what's happened here. We had a double top. Price came down, rejected it, and had a really big move. This move here from all the way there down is almost 10 or 20 straight days down without a retracement. So it does look as though we've got the potential here for a retracement. The question is, how far will that retracement go? So let's have a look at that. So from a trading perspective, usually you would have, after this, you would have anywhere from a 382 to a 50 fib to a 618 retracement. So if this is going to be our retracement, I think we can expect price to come back into this area here. So we're expecting, nope, that's not what I want. I'm looking for a retracement back into this area. The most significant price range that I can see here is 1.1, just over a little bit over 1.1. So I think that what we could experience this week, especially if we break above the high here and a break above the high here, is I would expect price to head back up, and probably this is the best, most suitable area for it to head back to. And then we could see price potentially continue to do that. We'll see. But that is my expectation for now. Okay, so because we're very overextended, big rundown. So if you compare the previous types of moves, this is the longest one we've had. We're very overextended. I think a pullback into this area makes the most sense. Then we'll have to see what happens. So this week, at least initially, especially if we break the high here or here and we form that swing low, I expect price to head back up to here. Okay, it's very overextended, which means for day traders should expect ideally within this area, there should be some very high probability trading opportunities. Okay, so there we go. So that being said, let's go and compare that. Let's go compare that here to the, so this will explain to you why the channel is still pointing up and price is still looking lower. And so the shorter term is basically going to be a price correction. This pivot has gone red, but the channel hasn't gone red. So we're in one of those very mixed periods. Remember that the daily Wave Rider is very safe. It's a very high probability, very reliable, safe trading system. What we're looking at now is a correction. There is no fixed trend. In fact, here's the trend. Here's the bigger trend to the upside, higher lows, higher highs. We've broken this, but we haven't produced a lower high, lower low. Okay, so basically we're sitting in a no trend area. which is why the daily wave rider has not given us a direction, because it's saying, well, we're not in an uptrend anymore, but we're also not in a downtrend. So therefore, we don't have that. Does that make sense? So therefore, the channel is pushing up, but the pivots are saying down. So shorter term this week, I expect to move back to the upside as part of a correction. Good. Hello, guys. So that's what I'm looking for here. So that's my expectation. If that's going to be the case, then I would expect also for cable to do a similar thing. So we'll go look at cable. So cable's not looking as bearish. You can see the cable has stopped at a level of support, and we could see it potentially, excuse me, we could see it potentially climb here. So shorter term this week, I'm looking for us to see pound and euro potentially climb. But first, we have to see them break a few highs here. They've got to follow through. So Monday, Tuesday, they've got to follow through to do that. The euro is very overextended to the downside, so the probabilities of it moving up is much higher. Aussie dollar, US dollar, also kind of stopping quite near a key level of support resistance. So that also makes sense as well. We've got Kiwi dollar, US dollar also here. This will start to show a little bit of level of support here. Again, a little bit of a double bottom. So what I want to show you something here, I'm going to show you a little bit of master trading stuff here. If this is slowing down, it's going to turn around. I want you to pay attention to what's going to happen now. So when we compare the low here to the low here, if it's going to turn around, we should be seeing bullish divergence. So what does that mean? We should be seeing on the indicator, we should be seeing bullish divergence if it's going to turn around. So we're going to go down to the 4 hour now, and we are looking for bullish divergence. So we have a lower low, we're looking for a higher low on the indicator. So let's go down to the 4 hour and see what we see. If it's going to turn around, that's what we would expect to see. So as you become more and more experienced, you anticipate what you're going to see on lower and higher time frames. So there we go. Let's just zoom out a bit. And here you go. You can see we've got a higher low. Higher lows here on the lower time frame and lower lows over here. So this is bullish divergence. So just to recap, on the daily, we're looking at euro dollar, pound dollar, Aussie dollar, Kiwi dollar. They all look, especially because they're driven by the euro dollar, which is the biggest currency traded against the US dollar. And that is looking very, very overextended. Could it keep going? Yes, it could, but it is already extremely overextended. So there's nothing wrong with it doing a little bit of a retracement, maybe a 50% retracement. And we can see when we look at GBP against US dollar, Aussie dollar against US dollar, and Kiwi dollar against US dollar, all of them are sitting at support levels. So all of them are showing that they are sitting at a support level, and therefore a move back up could actually make sense. What's interesting is when we go to Kiwi dollar on the US dollar side, we see, in addition to everything else, we see bullish divergence on the lower time frames. So what does that mean? It means that there is the potential for a change in trend to the upside. So how will day traders do this? So this is for the benefit of the newer traders. How do day traders benefit from this? They're benefiting from, if we are seeing euro dollar, pound dollar, Aussie dollar, Kiwi dollar all looking potentially bullish in the coming days, we would expect to see a change in trend. So how do you know you get a change in trend? Well, first of all, you have to start breaking above previous highs. So you have to start breaking above that. So in other words, what has to happen is you have to go from a downtrend into an uptrend. So part of that is breaking above previous highs, such as these. So you go over here, come down, and go up. So if that's going to be the case, we would see that on the 4 hour and the 1 hour. So for day traders who are trading the shorter term moves throughout the week, they would be expecting to go long this week. I want that to make sense to all of you. Does that make sense to all of you? So in other words, they're expecting the 1 hour and the 4 hour to go up for a few days at least, while the euro dollar retraces, while the Aussie dollar retraces, and so on and so forth. And so they look for a shift in trend to the upside. Supporting that is bullish divergence. So independently, whenever you see a situation like this, you can reasonably expect a change in trend, especially if you start to break above certain highs. Okay, so that is an explanation. So how do you convert that to a trading plan? Well, first of all, you need to make sure that you break above key highs. So you need price to break through there. Breaking through that becomes a bullish confirmation. It tells you it's gone from being bearish to bullish, but it's not an entry. You could possibly do an entry on a break above the high, you could, but the best entries are on a pullback, because when you get in on a pullback, the previous move has confirmed the direction. The pullback gives you a more efficient or price discounted entry. So you get a much more price efficient entry so that you can do the next move up. Generally speaking, the probability shouldn't have changed. Nothing else should have changed, but generally speaking. Okay, so that is what we're looking at on Kiwi dollar. Let's now go to the daily and let's have a look. So if we go through the larger ones here, the pound is looking bullish. It has an up channel. It's at the bottom of the channel and it's looking potentially bullish. So there could be a possible buy signal possibly here. For me, the safer way to enter this, it varies on all of you. You need your own kind of things. Is possibly an entry above that higher with my stop loss below here, or a tighter stop loss when we get to that. Because once we break above that high, we should potentially, the possibility of us moving back into an uptrend to the upside actually is back on the table. So that's a possibility. Let's have a look at Aussie dollar, US dollar. So Aussie dollar here, still producing the potential here for a higher low. We've got a bullish up channel, we've got pivots, we've got so on and so forth. So these could be, in the coming days, could be providing you with some bullish opportunities. For more advanced traders, there's higher risk possible opportunities here, but we might be looking at a possible continuation to the upside here. So it's higher risk, but that could be the case. When we look at Kiwi dollar, US dollar, again, we've got that nice bullish up channel here. And so we might be seeing a bit of a reversal here in the coming days. So something to be having a look at. Okay, let's move on. Let's have a look at dollar Swissy, dollar CAD. So dollar Swissy is looking bullish at the moment. I've been talking about this for just ages, about them becoming more and more bullish. It looks as though it's found some nice support. So dollar Swissy might, in fact, continue to look nice and bullish. Let's clean everything up here. So we might see a bit of a turnaround there from a daily perspective. Any kind of a pullback here could provide a buying opportunity. So we could see a pullback and a buying opportunity. So there might be some of that. We then have, so on the dollar pairs, there could be some opportunities this week. Dollar CAD has had a big move up and a very small pullback. So it's not really a good buying opportunity. Let's see how it looks when we have a look at what does dollar Swissy tell us here? Dollar Swissy is giving us mixed signals. So we need to see that channel turn around. So the beauty of the channel is the channel gives price enough time to really shift in terms of bullish to bearish sentiment or bearish to bullish sentiment. Gives it enough time to shift that it then adjusts the channel and the channel becomes bullish. So the channel, it's saying that it's too soon to be bullish on dollar Swissy. Dollar CAD is also saying it's too soon. So that's fine. Dollar yen, let's move on to dollar yen. Dollar yen, you can see it's very slowly turning around here. Let's look at dollar yen from again, I would prefer a bigger pullback here. So this is a minor pullback, and arguably that's a setup. It could keep going. I would have preferred to set up a pullback to here. So that's actually a better pullback. So as you become more and more experienced with trading, you get a sense of what constitutes a very big pullback, and therefore when you're due for a retracement, you get a sense of where price is supposed to, or where it should be pulling back to, at least to one or two different levels. So you get a variety of different things. Okay, so we are looking at dollar yen here. So dollar yen, I would be looking more for a pullback to these areas here and looking to go long if that's going to be the case. All right, so you could get a pullback to here, but a pullback down here makes way more sense. This is a much more sensible pullback area, and then I'd be looking to go long. Shorter term, we could see price heading lower. So the point here is that shorter term, we could see that weaker US dollar. It supports the euro dollar move, and we can see a pullback to those particular areas. Is how I'm talking about stuff here making sense, guys? Does it make sense to you? Is the analysis making sense? How can we go long then? Daniel, can you sorry, I was jumping between different currency pairs. Can you tell me which chart you're talking about? How can we go long? Just tell me which one you were talking about, and I'll go back to that and I'll answer that question. Okay. All right. So let's run through gold quickly. I'll run through the other pairs afterwards. Just recap which one you wanted to have a look at. Okay, thanks. Apologies, because you might have been talking about euro dollar and I just moved on before I saw the question. Okay, let's have a look at gold quickly. Okay, so gold, all right, I'm going to say it. Gold is definitely in a bubble. So what do I mean when I say that? Gold buying is it's just not stopping. It is absolutely massively overextended on the month, but it's not stopping. Okay, so the last time I saw gold kind of really move like this is a couple of periods here. So there's this period, sorry, terribly drawn, and this period here. So gold is definitely in a bubble. And by the way, the last time it was in this bubble, there was all kinds of talk about how you've got to buy gold, it's never coming back down, it's never going to come back down. And it subsequently came back 2011 and didn't start uptrending again until 2019. So almost 8 years where it lost that. So I just want to reiterate here that if gold, which is our oldest living currency in terms of metal at any rate, could fall out of favor with the public for 8 to 9 years, I'm telling you, it can happen with anything. So nothing is bulletproof. So the reason I bring that up is because, yes, we could see gold continue to go up, but we could also see gold come back down for 10 years. That could happen. So just, if you think it's impossible, this is the very first time, at least in recorded history, where gold just fell out of favor for a very long period. I should go back and have a look during the World War I and II, and see what happened there. But at least during my lifetime, the gold was just, nobody cared about gold for like 8, 9 years. But at the beginning, they were like, you've got to buy gold. It was absolute mania. So we are definitely in a gold bubble. We are definitely in a gold bubble. Okay, I want to express this to you. So for any of you who have started your trading now, I want you to understand that gold very rarely does the kind of moves it's doing now. And that when it does eventually, when the market is saturated with gold, it will have a correction. Could that correction come all the way back down here? It could. Doesn't have to, but it could. So why am I telling you this? I'm just remarking on the fact that gold is in a bubble because, first of all, because every time it's had a big move like this, it turns to crap, excuse my language, but basically it becomes a very unwanted thing for quite a long period of time. And so we need to be prepared for that. Okay, and when this has a correction, it's probably going to have a 50% minimum correction, which means that we can reasonably, I'm just putting it where it is now roughly, but that means we can reasonably expect it to come back to about here. Okay, so if not further, but we could expect it to do that. Okay, so when gold's going to come back down. Okay, now, and I assure you, as much as you might feel that there's no way this could ever happen with gold, I've seen it happen in my lifetime, so I know that it can happen. And there's never a reason for it until there's a reason for it. So just be cautious is my point here. But yes, it's bullish. It's overextended on the weekly now. On the daily, it's heading off. But it is, why I say it's in a bubble is because it just keeps going. So according to the strategy, you keep buying. You buy until you just don't need to buy anymore. So that means that if price comes back down and it gives you a setup, you take the setup. And if it keeps going or it turns around, then that's a losing, that's a losing trade. But you take the setup. But is gold in a bubble? 100%. Yes, it is. Does that mean it could keep going for another 6? I don't think it'll go for another year. I think it'll probably go for another, somewhere between another 3 months to another 6 months. Okay, so here we go. Euro dollar. Okay, gold is noted, just sold after all-time high, felt dangerously too. Gold, let's flush up rather than slowly moving up. Yeah. Euro dollar. Okay, cool. So thank you, Daniel. And I love the questions and the comments, by the way. It means the world to me. I prefer that. So we're just quickly going to go back to euro dollar so we can have a look at this one. Let's just go back to this. Okay, so the question was, well, if I understood you correctly, how can we go long then? Okay, so the pivots, the rules are for the daily wave rider for the newer traders, your channel's bullish, but your pivot is bearish, which actually means you don't take a trade. And that's true. For the more experienced traders, why would we take this trade? Okay, so let's talk about that. Let's go to the weekly first of all. So first of all, let's go to the weekly. So from a weekly perspective, we've double topped, we've broken this, we don't have a lower high, lower low, but we've definitely come back down. From a monthly perspective, we're still in an uptrend. We've got a low and a high and a higher low and a higher high and possibly a higher low. Okay, so there's an uptrend from a monthly perspective. So just kind of keep that in mind while we keep going. From a weekly perspective, we have no trend. Why do we say that? Because you've got a higher high here from this high to this high. We broke this low, which means that this uptrend is no longer intact. We've broken it. Because remember that everything goes from an uptrend to a downtrend to sideways to no trend to downtrend to uptrend. There's always a point at which you break a low or a high which ends the existing conditions and creates new ones. So at this point, the second we broke this one, we ended the uptrend, but we haven't produced a lower high, lower low, or anything like that, so we have no trend. So now what's happening is we're in the domain, not the beginner domain, but the more experienced trader domain of trading with less of a confirmation of the higher time frames, but kind of what's the shorter term likelihood. So what is the shorter term probability? Are we heavily overextended to the downside? Yes, we are. This is an incredibly long move. So if price goes up this week, we could treat it as a retracement. We could treat it as this is being a correction for after this move. So after the market has a really big move one way, up or down, there's a reaction the other way. So now we're operating within a very small window of what is most likely going to happen, but it's not within the traditional window of, well, we're in a weekly uptrend or a monthly uptrend. We're not. We're just within if we look at the daily, it's heavily overextended. We think there could be a correction. And if there is a correction and we get it, we have it happen now. Could it keep going? Like I said, it could keep going, but this is already very extreme. This is very, very extreme. And therefore, so as traders, we deal with logic and probabilities. I know that this is a very extreme move, and therefore I know that a bit of a retracement here would make sense. The retracement only begins when you actually kind of break there, because you need a swing low. So you need your candles to do this. You need to break above a high, so you get that swing low. So your candles are coming down, and then they're going up. You need to break that high. So we would need to break that high to get that swing low. And if we did that and we started it, what happens then is buyers start coming in and sellers start getting out. So it's always cause and effect. The market's organic. As soon as the market starts doing something, the more experienced people start adapting to what it's doing, which actually adds to the momentum. So if they realize it's starting to go up, they'll probably, and they are sellers, they'll probably start getting out of those positions. And if they're bearish, they'll start selling. So what happens is the market basically starts to follow through. Excuse me. And if it does, a Fibonacci retracement to the high indicates that the average is very overextended, which means that the pullback to at least what we could call the sell zone or the buy zone, this area here, the 618 to the 382, this area becomes very high probability. But in addition to that, we can see really where the really big levels of resistance are. There's one here, which is support here. So we could come back to this. We could, but it's really overextended. So the more the market is stretched, the more it tends to kind of contract when it comes back. So I think probably not that one. There's a bit of another level here, sure, which is close to the 382. So I think I'm going to remove this. I would think that the minimum correction the market does is probably back up to here. Failing that, I noticed 618 is up here, but that's quite far away. The next sweet spot is here. We've got a nice little test of resistance, nice little test of support, which is why I mark this whole area, because all of these become valid support resistance levels. You can see here when you kind of put a level there, where you touch with this one, you get a bit of a level there. So you get kind of a 50 fib, which makes a lot of sense, and you get a 382. I think somewhere into this area is the most likely, which means for day traders are going to be looking for trades back into this area, day traders. Okay, maybe the 4 hour back into it. End of day traders are probably not going to trade this. So my point here was to explain to you the logic behind day traders looking for it, but also what end of traders would be doing. So you wouldn't, strictly speaking, be going long as an end of day trader. You temporarily, when the market is correcting, take advantage of that on the much lower time frames, just between this distance and like this distance. Just between there and there, you'd be looking for a buying opportunity. Okay. Cool. Okay, I want to just run through a few other things and then we're going to wrap up. So the markets imply that the dollar would weaken against a lot of the other currency pairs. Let's have a quick look. Let's go back to gold, please. So gold, I spoke to you about that. I am very cautious of that. It's still very bullish. Long story short, we would be looking for any kind of pullbacks here, looking for a buying opportunity this week. But the risk of the overall change in trend is definitely on the table. I would highlight here, for example, you've got a fresh iron price, but you can see the MACD hitting lows. You've got bearish divergence. But what you would need to see is you'd need to see a very bearish daily candle, very strong rejection at a key level, which would probably indicate a bit of a reversal. We don't see that yet. So what do you do here? Well, you maintain trading with gold, with the trend, but maybe if you're concerned about that it's become very overextended, what do? You can either not trade it, demo trade it so that you still get the learning experience from the placing the trades, calculating the risk, and whatever the outcome is, you still get to write that in your trading journal. Or you reduce your risk. You say, instead of 1% on this trade, I'm going to put 0.5% or 0.25% on the trade. So if it goes up, keeps going up, I make money. But if it does reverse, I lose less. Okay, so that's again what you learn from the more experienced stuff. Let's have a quick look at crude oil. So crude oil, if you look at crude oil from let's go and have a look at it from a much higher time frame perspective. What do we get? We get a series of progressively lower highs, and we get a form of a level of support here. I'll just do that. So you've got a low here. So you've got a low here, a low there, a low there, a low there. But you've got a definite series of lower highs. So the sellers are winning because they keep pushing and pushing and pushing. And this is holding, but they are pushing and pushing and pushing. So eventually my expectation here is that we will see crude oil break lower. When is that? Well, that could be in January. Because we're on a monthly time frame, we can't see that. So let's go down to the weekly. But what we can see is effectively where we kind of get towards that area. So you can see here is probably around about the $65 mark. It's probably where we would start to break through. So I'm bearish on this, but we could still get a couple of bounces. Is it possible we could sort of bounce here and then go up here? We could get that. So I would really wait till we start to break below here before I start shorting the markets. But it is bearish, okay? It's bearish. Right now it's bearish. Is there any way the market could break up above here? Yes. If it broke through that, then this whole pattern is failed. But the odds of that are happening is like probably around 19 to 81. So like 81% chance it's going to break down, 19% chance it's going to break up. Like it's very much favored to the downside. That's from experience, that's from statistical analysis, like a bearish breakup pattern. There's certain things. Okay, so we go back to the daily. So what would I expect to see here? Well, I would expect the channel to be bearish. The channel should be bearish, even though we have an uptrend temporarily. The momentum is definitely leaning to the downside. So let's see what it looks like when we go and have a look at it here. So here you can see the channel is, because the channel's looking at the longer term trend. The channel's bearish, but it's bullish here. So how will we know? I would be getting ready to short this when the pivots go red. So when the pivots start to go red, there could be some red, because that means the channel's bearish and the pivots are bearish. Could be some good shorting opportunities. But also just to draw your attention to this key level here, which price is going to have to break through. So in general, I'm bearish on crude oil. I'm cautiously short-term bullish on gold, but definitely longer term, I expect a bigger correction on it. It's in a bubble, but bubbles are annoying because they can go, it could still go for a couple of months. But when it has a correction, I think there's going to be some good, decent correction on it. Okay, so we've looked at the dollars, we've looked at all those. Quickly, let's finish up on the indices. So let's look at the S&P 500. So why do we look at the S&P 500? The Dow is the oldest. The Dow is the oldest, but the S&P 500 has a 500 constituent sample size. So your sample size of companies that are global companies, like your Starbucks, your Nike, Amazon, all these different companies, all obviously they're in NASDAQ as well, but they're in the S&P. So they're all nice and bullish. They're very nice and bullish. Are they overextended? Yes, they are. Here's where it gets interesting. Ladies and gentlemen, we have the most important election in our lifetime since World War II in 2 weeks' time. Tuesday, the 5th of November, I think it is. Tuesday, the 5th of November. It's usually the first Tuesday of, is that right? The first Tuesday of November. Should be the case. Let's just see if that is the case here. First Tuesday. Yeah, okay. So I think it's the first Tuesday of November. It'll be the 5th of November. US election, that means I would just stay out of the markets, absolutely stay out of the markets in the weekend running up to that. So make sure that your exposure is minimized by the Thursday or Friday. It's not that far away. It's a couple of weeks away. Make sure that you stay out of the markets until the Wednesday or Thursday, and then start to do it. Yeah, exactly. Remember the 5th of November. Everybody has their different opinions. Everyone has their different opinions. I'm of the opinion that it is going to be a landslide. So everybody has their different opinions, just to kind of register this. I am of the opinion, Paul knows this, that it is going to be a landslide victory for Kamala Harris, for democracy in the US. It is going to be a blowout. I think there's a possibility Texas might go blue, Florida might go blue. However, I also anticipate that the opposite party, the Republican Party, are going to attempt to undermine the election. I know they are. I think they're going to attempt to purge voters and reject results and do all kinds of nonsense. But I think it is going to be mind-blowing how blue it goes. Main reason is taking away women's rights will be the single biggest driver. Taking away women's rights from reproductive rights, all kinds of crazy stuff you don't want to even know about trying to get teenage girls pregnant, trying to bring back lynching, trying to legalize lynching, trying to take away black votes. It's insane. And it's very much pre-Nazi Germany stuff. It's crazy stuff. So I think it'll go blue, just to say that. I think it'll go blue. I think it'll be a big success. But the markets will be unhinged. The markets are going to be very much on tenterhooks. That includes the currencies, commodities, because it's dollar based. So just be very, very cautious around that time. But the markets are bullish, but we could get a bit of a reaction. So I think that could happen around January. So in January, we could see a period that looks a little bit like this. We could see a little bit of a correction like that or like that. In January, I think the markets are going to push through like crazy. I think they will do that if it's Kamala Harris that wins. I think they'll keep pushing. I think if Trump wins, I think we'll see a massive correction. The only reason for that is that a lot of instability. So this is the Trump period here. The market is very uncertain, doesn't know what's going to happen. When it's Biden, which was Obama Biden and Biden Harris and then Harris, it's generally very bullish. Okay, so just if you look at that, this previous period is Biden and Obama, this is Biden Harris, and this is Biden Harris, and this is Trump. So I think the uncertainty, I know that we all have different, some people have different opinions on it. That's fine. This is just giving you what my expectation is on that. Okay. And so I think we're looking at a very nice bullish result. When we look at this, it is overextended. On the weekly, it's overextended. We will have some corrections. I see any corrections for now, shorter term corrections, I see as buying opportunities, guys. I expect that to continue. Okay, so buying opportunities. With the FTSE, it's too noisy, it's too choppy, but it's still pushing up. I think there'll be a breakout. So here we might even see a little bit of a bullish breakout pattern here. So a lot of these will give you a bullish channel, bullish pivots. I would go through that. If you're not convinced that's going to be the case, then reduce your risk or demo trade it. But overall, these markets, I expect them to continue to be bullish for the time being. They are a little bit overextended. We will have some corrections hopefully in January, so we can deal with it in January. One last thing, because I know we're wrapping up. One last thing. The markets do very little from around about the 15th of December until about the 5th of January. Okay, from around about the 15th of December, somewhere around this period, the 16th, because then it's in the run up to Christmas and people are checking out already. So this will be the last week of the market movement, 16th, 17th, 18th, 19th. People are gone on the Friday, the 20th, and they won't really come back. This is New Year's Eve. They won't really come back probably until after that. So from around about Friday the 20th to the 5th of January, the markets are going to be all over the place. They'll be either moving or not moving, but they'll be very unpredictable. And the people are at home with their families and not trading. So the market volatility and volume will just be a fraction of what it is. Take my advice and take the time off. Spend that time learning the educational material, doing your analysis, but don't actually trade. Just do studies or take a break from the charts, spend time with your family. It's very good for you to do that. You come back in the new year, you're all refreshed. The market's not going to be doing anything. It's not going anywhere during that period. Okay, so if no one's told you this already, you need to know this. Nothing happens during that period. Just take a break. Okay, I'm going to let you go with that, guys. Thank you very much. I hope that you found this constructive and useful. That gives you a good sense of where the dollar is this week. I expect us to see a bit of a weaker dollar, and that could see it. Gold, as I said, all the various different things. But I'll let you go now. But again, thank you very much, and I do hope that you found this instructive.